Good morning, students. This is your accountancy teacher, Gurjeet Luthra. The chapter we are starting today is Journal. Basically, let's have a background of journal. Actually, this chapter is the base, it is the foundation of all our accounting system. And so you have to make it clear that whatever problems you face, feel free to ask because on this chapter, the whole accounting is based. So let's start with what is journal. Journal is the book of prime entry in which all transactions are recorded in a chronological order. Now, what do you mean by chronological order? That means date wise. That means whatever transactions we are noting down or recording in the books, so they are to be noted down in chronological order. That means date wise. Now basically the format of journal is first column is of date, then particulars, LF. LF stands for ledger folio. For the time being, we don't have to concentrate on this. We'll see it later on. What does this mean? Basically, it means the page number on which a particular account is to be recorded. Next column is debit amount in rupees, credit amount also in rupees. So whatever account is to be debited, it is written dash account debit and the amount will come in this column. And whatever account is to be credited, we have to leave a little space here, and then the credit account is to start with 2 dash account. We don't have to write the word credit, and the amount will come in the credit column. It is followed by a narration of the transaction. It will start from being and then the description of the transaction. We'll see how to do that. So this particular thing is called journal entry. Now let's start. How to pass a journal entry. Steps. Now let's take a transaction. Like the transaction is, for example, the transaction is paid cash to Ram rupees 10,000. Now let's elaborate this by taking the various steps which are involved in passing a journal entry. Step 1. Identify accounts involved in transaction. So here the accounts involved are, one is cash and the other one is Ram. Step 2. Classify these accounts. Now the classification is according to CLEAR, that CLEAR rule which says capital, liability, expense, asset and revenue. So let's see. Cash is an asset, okay, and if we are paying something to Ram, so that means Ram would have been a liability to whom we are paying. Step 3, apply debit and credit rule. Now as we see, cash is an asset, and can we see one thing, that this cash is increasing or decreasing? We can clearly say when we are paying cash to Ram, so the asset is decreasing. Asset is decreasing. So decrease in asset, it is to be credited according to our clear rule. Then the second account, Ram is a liability. So when we are paying cash to Ram, so that means our liability is also decreasing, which implies decrease in liability is always debited. Step 4, pass the journal entry. How we are going to pass the journal entry? So again, let's see with the help of that format of ours. The format was date, particulars, ledger folio, debit amount, credit amount. So our journal entry, we can see that Ram has to be debited and cash has to be credited. So our journal entry will be Ram debit to Ram debit rupees 10,000 and credit will be to cash account 10,000. We haven't written the word account with Ram, the reason being that we do not attach the word account with the human beings. Always remember this. So it will be followed by a narration. Narration will be being cash paid to Ram. This is how we pass a journal entry. Let's take another example. Started business with cash rupees 1 lakh. Now applying the steps. First step was identify the accounts involved. The accounts involved are cash. Number 2, capital. Cash is an asset. Capital is itself capital. So now let's apply the rules of debit and credit. Here cash is increasing, hence it is to be debited. Capital is also increasing, and increase in capital, according to a clear rule, increase in capital is credited. So our journal entry here will be cash account debit 1 lakh to capital account 1 lakh okay, being business started with cash. Let's take another example. Purchased goods on credit from Mohit rupees 20,000. Purchase goods from Mohit rupees 20,000. So the accounts involved here are number 1, purchases account. Number 2, Mohit. Purchase is an expense. Mohit, because he's a creditor, so that means he's a liability. So here expense is increasing. Increase in expense is always debited. Here liability is also increasing, and increase in liability is always credited. So our journal entry will be purchases account debit to Mohit 20,000 being goods purchased from Mohit. So this is all about our journal entry concept. So I hope it's clear. We'll be following this chapter slowly and with some more illustrations in my next video.